Hello everyone, my name is Renee and I'm the financial journalist from FSN1.com. In this video, I speak to Reginald Tan, the head of multi-asset product for Southeast Asia from Schroders, as he shares with us his take on global equities. How has market volatility affected the portfolio?
As you know, last year, 2018, it was the US assets which did very well, whether it was equities or the currency. So we've managed to lock in some profits on the dollar, and we've actually been moving it to Asian currencies, which have actually been doing better for us. So generally speaking, yes, volatility, meaning downside, has not been good in that sense, but we have been moving in the right direction to take advantage of the opportunities which we think will exist this year.
What are some adjustments to the fund as a response to recent market events?
We feel that because the Fed is less hawkish today, given the growth slowdown expected globally in the US as well, we've actually been spreading out our purchases from the broader market in the US, let's say the S&P 500, to the smaller cap areas where we see interesting growth opportunities.
What events could affect the portfolio in the future?
In the near future, there are lots of things to look at, both upside and downside. As you know, we are heading towards the US re-election in 2020, and it's pretty clear from our perspective that Donald Trump is gunning for that. And he knows also very clearly that the US economy is slowing down. From our own Schroders numbers, we see the US GDP growth falling from 2.9 last year, 2.9% GDP growth, to 2.4 this year, to 1.3 next year. So it's not anything that he's done. Well, to some extent it is. He passed the tax bill in 2017. So that's falling off, which is why the US growth rate is falling off. Which also leads to the fact that he needs to do something to support the economy. And the easiest way really is to undo his own damage, which is the trade war. And that's why at this time you have the Chinese and US officials meeting to discuss measures to possibly do something about it. The US economy is slowing down, the shutdown isn't helping. We also see the Fed, as a result, being a little bit more dovish, which is in a way also good for the equity risk markets. I mentioned China earlier, and I think that's also something we see as quite interesting because the markets have been hit very hard in 2018 along with all emerging markets. So which is obviously the monster in the region for us in Asia, if that works out, also will be positive for us for Asian equities.
What areas should we avoid or be cautious of in 2019?
We're not very keen on Europe. Growth has broadly disappointed. They actually had to raise rates first. So that's what they're doing. And that's not coming at the best of times. Yes, the economies around Europe are recovering, but definitely not as much as expected. And it doesn't help when you have a major economy, for example, like Italy, which has recently gone through its own issues about growth and the fiscal problems, the budget deficits, the lack of a government, etc. So broadly speaking, we find that to be a bit of a messy situation, coupled with lots of political problems. So something that we're a little bit more shy of.
Don't forget to like our Facebook page for more investment ideas and comment down below for what you would like us to cover next.